If you're like me, you love making money in real estate. If you're like me, you also hate having to pay taxes. Fortunately, the government provides two mechanisms to avoid capital gains taxes when you sell properties. One way is to die, which I don't recommend. The other way is called a 1031 exchange. In this episode of the Land.MBA podcast, Dave and I are privileged to speak with Cory Thomas and Jay Jacobson. Cory and Jay are expert investors in multifamily properties using 1031 exchanges. Listen on as they explain to us how they've built large real estate portfolios while really minimizing their taxes.
Welcome to the Land.MBA podcast, where we go deep into the business of land investing.
Hey guys, how's everybody doing today?
Doing well.
Awesome. Great. Well, hey, I'm really excited to have you guys on. Today we have on the show Cory Thomas and we have Jay Jacobson. And of course, my partner in crime, Howard Zonder, and myself, David Van Steenkist. Hey guys, let's just jump right into it. Cory, tell us a little bit about your business and what brought you here, and then we'll let Jay give his spiel, and we'll get to chatting about it.
Hardcore questions.
Okay, sounds great. So our firm is Income Property Advisors, and it's my brother and I, and we specialize. I've been in this business for 21 years, and really what we do is we specialize in management-free, income-producing properties that qualify for 1031 exchange investments into and out of these properties. About 80 to 85% of the properties that we offer our investors and invest in ourselves are multifamily, or have been in this most recent cycle expansion phase from the bottom of, say, 2010, 2011. It's been about 80 to 85% multifamily, but we do offer a lot of other asset classes as well. Jay Jacobson here is a client of mine, and he's invested in an Amazon distribution facility as an example.
Jay is cleared every month.
Yes. It's a long-term triple net lease. They're under market on their rent, and then we also have single tenant, necessity retail, as well as self-storage. We even have had mobile home park manufactured housing communities. We have a couple coming up in Florida. And really our focus is helping our investors find the properties that are going to perform the best, both from a cash flow standpoint as well as an appreciation standpoint. And so when we run our analysis, we look at where is the appreciation going to be and where is the rent growth. And so our criteria are, we need growth. We really don't want to recommend properties unless there's growth, job growth, wage growth, population growth, and rent growth. And we also like and prefer close-in locations that's close to the economic center, whatever's driving that economy as possible. And then finally, we look for infill, and with multifamily in particular, especially in places like Texas, where it's less expensive to build new properties, competition is often the factor that might keep the rents from increasing as much as it otherwise could. And so we really, particularly in Dallas and even Austin and Houston, we like infill locations where any new competition is going to have to tear down or any new supply is going to have to tear down an existing use type property, which makes it more expensive. And so with those criteria, we really help our clients invest in not only management-free properties that provide monthly income, but also properties that are going to protect their principal and appreciate in value. Most of the properties are, they're bought on the open market. It's very rare to find a steal like you might with your land investments. So you're paying right around market value. So it's more, all of the analysis is more, future analysis as opposed to getting a big discount today. Sometimes we do. Sometimes we'll have a property that the appraisal will come in above the usually at most maybe 5 to 10% above the acquisition price. And now the acquisition price is the price that has, because the companies that are offering these properties have fees and setting them up, and they have an acquisition fee. So there's fees involved, and the acquisition price is the total all-in price. If you invest $200,000 in one multifamily property, then you're getting your, say, 6% distribution on that entire $200,000, and then all of our analysis in terms of appreciation and what your potential profit might be, or when it sells, what your actual profit is when you exchange out of it, is based on that entire $200,000. And so that's it's, in a nutshell, about 90, maybe 91, 92% of our investors are involved in 1031 exchanges. And then we also have cash investors. I've invested in almost as many as Jay, smaller amounts, but in 17 of these properties. And some of them, I'm in quite a few with Jay Jacobson here. So
gotcha.
Your notes.
Are these primarily accredited investor type levels, or can non-accredited investors also invest in these?
Ours are all for accredited investors only.
Gotcha.
Reg D offerings.
Gotcha. Okay, cool. Very good. So Jay, tell us a little bit about how, your real estate career and how you got started and what brings you here today, and how you and Cory got connected, and then we'll kind of tie everything together here.
Well, I wish the camera would show my gray hair more, but
Showing enough.
I bought my, I was a little jab at, we don't know what color Dave's is. But, 1970, my wife and I purchased a duplex 50 years ago, January. And we had just a fun time seeing how high we could raise the rent next door. And we had probably 3-4 turns, and it was great. And I was, at the time, I was with IBM in marketing. And that was, a great training ground that they gave me. But, how many typewriters can you get excited selling? And I got thinking, this real estate could make some sense. So I got my broker's license. As with my total thought is I want to get into more investment. And so I started buying an occasional house and then condos. And in about 77, I got started on land and investing on some land and selling it and doing all that. But on the houses, they evolved into an apartment. I was financing. I was in with a large savings and loan financing apartment complexes. So I did 515 apartment loans.
Wow.
Over my years. So I got to know living and breathing apartment complexes, what you could expect, location, construction, et cetera, et cetera. So I thought this is pretty cool. And I was seeing a lot of people making a lot of money on it. So I ventured out and bought a 22-unit apartment complex. And then the guy I bought it from was a broker, and he said, "Hey, I found another 21-unit down the street, about 3 blocks away. Why don't we buy that?" So we bought them both. And it was, a lot of fun. And we're managing them away. And then he says, "Hey, my investment brokerage life is, I need some spark in it. I'd like to advertise some. Why don't I advertise our properties?" I said, "Well, what price?" He gave me a price. I said, "That's nuts." And sure enough, in about a couple months, we had a full price offer. And then I had to go into really 1031 because I'm averse paying taxes today. I'd much rather put it off to when I'm not around. And so I had those on a contract, and I had a good friend of mine that was a broker that was dealing in a lot of Texas properties. So we flew down one long weekend, looked at 22 apartment complexes. The second complex is the one I settled in on. I said, well, why the heck did we waste all our time looking at those other 20? But that's another story. Operated it, upgraded the rents, upgraded, rehabbed. Got tremendous manager in there, and we figured out, I told the resident manager, give me a list of what we need to do with the property. So she gave me a list of 10 things. I accomplished 9 of them within 6 months. And so got that thing up where it appreciated tremendously. And so, well, why don't you sell it? Or no, I refied it, pulled out the money. My accountant said, no, you can't just look at that money. You got to put it into the investment. So I was buying more properties. And so then the broker I bought it from, he said, hey, I think we could get X amount. It was a big profit. We'll try it. And so I got into that. And so I exchanged into more. And so I was having quite a bit of investments in apartments. And my partner at the time, and he was a general partner in all these. I was a co-general on some of them. He says, I think it's time to sell a few of them. So I put 3 under contract. I took the amount of expected proceeds from the contracts and took it to my accountant. And I said, Jeff, what's going to be my tax bill? I'm thinking about just cashing out and enjoy our life with just having some money. And he says, sure, it's easy to calculate. So we had a lunch the next week, and it was composed of my accountant, my former accountant, and his partner. And he says, I got the numbers here for you. You will be taxed at 56% of your expected proceeds.
Oh, boy.
That's what I did, Howard. I was reaching for my heart medicine. I said, what can I do? Is there any other solution for it? He says, well, he says it's the capital gains, it's the depreciation recapture, it's the AMT, it's the Obama tax, and everything else involved. It got to the 56%. And he says, unless you exchange, I don't see a way out. And then one fellow at the table says, well, there is one way. You could die. Well, no, that doesn't sound peaceful. So I got hunting around. I bought a couple houses, some of the money, and then I got a hold of an associate of Cory's at the time. And before I gravitated to Cory called me and says, well, she's gone to another place in this world. And I'm taking over your account. So Cory and I started working and started investing in these different properties. He has a list, and I think it's an attachment. It shows about 35 properties.
Yeah, and we'll put that in the show notes for people.
Oh, good. So they can get a hold of it.
They can download it, yeah.
Yeah. And so it gives a little thumb sketch. If you like, say I like this Polo Glen property. God, I did like it, didn't I?
Oh, yeah. Yeah.
First one on the list. I went into it with my daughter. She and I own some rental houses in Colorado Springs. She wants to get out of the management thing. And so we went into that one. And then I just sold one 2 weeks ago, and I got another piece of it. Cory saved some for me. And so if a property looks enticing, I call Cory. He gets me an 8-page brochure, which gives the nuts and bolts. Then if I really like it, he sends about a 200 to a 350-page private placement memorandum, which, if you guys have trouble sleeping, this is a wonderful. It's better than
sleep aid, huh?
Because all the lawyers and accountants can tell you why you shouldn't do it. But it does excerpts from the appraisal, the engineer's report, the
property
underwriting.
Yeah.
And you really know the property. And if you're wondering about something, I've flown out and I've looked at probably 15 properties.
Probably more, yeah.
And I'm sort of on that. And so deciding on which ones I like. And so you select and say, Cory, I like it, and so he gets it reserved. There's a little purchase contract. It's about 10 pages. His assistant fills out for me because I'm horrible on paperwork. And I sign it and send it off. And then it's the sponsor. And these are large, they typically have 40, 50 properties, do you think, under management?
Yeah, it depends on the sponsor. Some of them have publicly traded REITs. So they'll have properties through their REITs, and then they'll also have properties through other funds. And so I'd say the average sponsor, probably about 50 to 70 properties under management. Some of them have 300 and some of them may only have 25. But in that,
and when we have, which is very seldom, but when we have conference calls, having been in the apartment financing industry, I got to know a lot of the players. And I tell you, these are pros. I can't get over especially when we have a problem of some kind or the other, like COVID-19, they get a hold of us. We have conference calls. They tell us each step they're doing, and they're spot on.
Yeah.
They really know what they're doing. And so you hold these. The intent is 7 to 10 years. I've had them flip in 4 or 5 years. If they get a good offer, they say, hey, we got something for you to consider. It's not our vote. We are limited partners. But there's one case, I'm thinking Riva, Norfolk. They came in and I said, well, you guys are paying 8 3/4% cash on cash. Where am I going to find something better? Well, it's a good price we're getting. Well, of course, it's a good price. And so they put it on the back burner. They came back and said, well, we talked them up another $1 million. What do you think of this? It still doesn't meet our purposes. We're getting great cash flow. You're leasing it all totally up. Let's forget about it. And so they did forget about it. But they can just say, we're going to sell. And then we just start the exchange all over. And I've had about 5, 6 of them have gone full circuit. And it's generally always with a nice profit.
Now, are these deals primarily, are they typically 100% private equity, or they also blend bank debt in with some of these deals?
Yes, a lot of them will have CMBS debt, Fannie Mae loans on the multifamily, and some of them are free and clear, but about 85% of them have debt.
Gotcha. Okay,
and it's usually pretty conservative. Yeah, 50%, right around 50% LTV, 10-year terms mostly. And with the multifamily, it may be interest only for 5 years. Starts 30-year amortization for the remaining 5 years, and then the payoff at maturity at 10 years.
Very good. So, hey, real quick, just to recap what we're talking about, we've got Cory Thomas on here, who runs a brokerage that facilitates 1031 exchanges into cash flow properties. We've got one of his clients on, and actually one of my business partners on some properties, Jay Jacobson. And Jay's one of his clients who's done a lot of investments with him as his investments have grown through the years. And to avoid paying the tax man every time he sells, now he can 1031 exchange, which is a method that allows you to upgrade into another property and put off the taxes. So before we talk more about that, I just want to talk a little bit about our sponsor, LandSpeed. Hey folks, my name is David Van Steenkist, and I've been a real estate investor for over 10 years. I've used lots of different tools, but none of them has done for my business what LandSpeed does. LandSpeed covers every step in the land investing process, from ordering mailing lists to marketing, sales, and closing the deal. What I really like, though, is it anticipates my needs. When I think, oh, I wish I had a quick and easy way to evaluate return on investment on a potential property, look no further, LandSpeed does it. If I want to edit a deed after LandSpeed creates it, it can do that too. Most systems just stick you with a PDF that's uneditable, and you got to go back into the system and edit the fields and do whatever you need to do, and it's a real pain in the rear end. LandSpeed simplifies it. If I want to send 1 or 5 or even 40 neighbor letters at the click of a button, bam, LandSpeed does it. But even with all that inherent capability, you get access to LandSpeed Community, you get weekly mastermind calls, and you get the best mailing rates in the business with no volume commitment, which is freaking awesome. Because if I just want to top one contract to somebody, I don't have to pay $1.50. I still pay the bargain basement rate. And on top of that, customer service is stellar, quick, and they just do a great job. I've been very, very happy, very pleased with it. And look, I've been running my business on LandSpeed for over 2 years. So take it from me. If you're serious about your land business, then check out LandSpeed at facebook.com/landbizautomation. That's land, B-I-Z automation. And if you want $100 off, tell them you heard it from me, David Van Steenkist, on the Land.MBA podcast. I've one question. When you get to a point on the where you sell one of these properties, do you facilitate your current investors of the property that you're selling a natural 1031 into a new property now, or do most of them cash out? How do you work that?
Almost all of them will 1031 exchange. Actually, a good percentage of our business are investors who have exchanged into these what are called DSTs for Delaware Statutory Trust. It's actually a business trust structure. It's unique. The IRS issued a revenue ruling 2004-86 that spells the terms out or lists all the requirements for these to qualify for 1031 exchanges. But the majority of our business over the last 3 to 5 years, probably by a slim margin, the majority of our business have been investors coming out of DSTs that they exchanged into and now exchanging into another DST, or sometimes they'll split it and go into multiple DSTs from one.
Gotcha. Very good. So I just want to tie this conversation back to most of our audience is land investors and or would-be land investors, but land investing also appeals as another stream of income for people who have been doing perhaps houses, flipping houses, wholesaling houses, and or apartments, doing apartment stuff or small multifamily. And so to me, I think it ties in very nicely because let's take Jay, for example. He started young, built a property here, property there, did some houses, did some land, built up his capital to the point where now 1031 exchanges make sense. Some of our listeners may be thinking, well, I don't have any money to do that with. Well, land investing is a great way to do that, to start building up your capital, both cash flow and capital. But the nice thing about these kind of cash flow properties, when you get to the point where you can invest in those, is that they're forever cash. You decide to sell them at some point, but you can hang on. They can cash flow forever or a very long time. Whereas when we're selling land on terms, now granted, sometimes you get properties that default, you resell. They default, you resell. You might have them quite a long time, but it's still something that you have to work because the notes eventually pay off. So a lot of people are using land and selling on cash to build up their nut, and then maybe put it into a house or part of an apartment investment and keep building that equity up. While at the same time, you can be cash flowing your terms deals. So then you get into a position where you can invest with Cory.
Yeah. It's interesting. I within the LandSpeed community, we've got some people who are new into the land investing and they're just getting started in this real estate game, trying to figure out how to extricate themselves from the corporate job. we've got other people who are much more senior, seasoned and experienced investors who are either turning 100% into land or land as one of the asset classes, and they're also very much involved in other asset classes as well. And but a lot of times when I hear this over and over again, people saying, I did the house flipping, I did the investing, and usually it's maybe duplexes or something like that. Very rarely is it large multifamily, but it's like I just don't need it. It's too much of a hassle. There's the contractors you have to deal with, and tenants, and there's all these problems, and I just don't want to be bothered with it anymore. But what I'm hearing here is a way to get involved in this larger project, multifamily world, which is generally a very good business to be in, without having to personally be responsible for all of those, for the management and all of those time-consuming and frustrating parts of the business. Is that right?
Yeah, that is right.
Exactly.
Yeah, and with a business trust, you don't have to. There's another structure that also qualifies under a co-tenancy or tenant in common structure that used to be the favored structure years ago in the previous cycles. And that under that structure, each investor had to have a single member LLC that they had held their interest in, and that was to protect the co-investors and to protect the property from any liability on the investor side. With a business trust, it's a bankruptcy remote entity. Each investor is completely passive. There's no annual fees, and it's the only legal structure. If there is debt on the property, it's the only legal structure where the IRS gives an investor in a 1031 exchange credit for their total replacement value on the debt with the individual investor himself or herself not being a party to the loan. And so it's really unique in that way. And then also because the companies, the sponsors that are offering these properties oftentimes are huge multi-billion-dollar companies with publicly traded REITs, they're achieving the best rates. The economies of scale for insurance, for the mortgage, the interest rates on the loans are all really top tier. And so you can go in without any lender underwriting. The lender doesn't even know your name, and you get all the benefits of the debt, but without actually being a named party on the loan, or when you go to refinance other properties that you own on your own or your house. The loan itself is not part of your debt burden.
Total non-recourse financing.
I love it.
I haven't kissed the paper on any of these deals.
That's nice.
Which, as you know, lately, especially in COVID-19,
yeah.
I mean, it seemed like lending standards were loosening a little. And I know in refi, for me, I have a blended portfolio of DSTs, and then I have local condos in Colorado and in Virginia and in Florida. But so I have a blended portfolio, which I really like, although I'm getting fed up with some of the range we had in Southern California. I had 2 properties at once right around Christmas with leaks. And so, it becomes a hassle, but with a blended portfolio, it's really nice. But when I refinance my local properties, I mean, the amount of scrutiny that a lender puts you through, even with an 800 FICO and good income and good tenants, the amount of scrutiny that lenders are putting investors particularly through is rigorous. And under the current COVID-19 situation, seems like that has ratcheted up again, because I've been getting a lot of emails from investors asking for descriptions of the DSTs and how they work and so forth.
I wanted to give a quick COVID-19 summary because everybody had their pants scared off. What's going to happen? Suddenly the tenant flow is they're going to stop paying rent, and you can't evict. They have these eviction laws and everything else to make it sound so terrible. But of nearly all my properties, we've been getting some conference calls, we're getting memos, etc. And we're averaging over 97% of our rent roll being collected.
That's pretty darn good.
So this thing about falling off the cliff has not happened. A lot of, a number of our tenants do have a payback return thing. And some people say, well, are your partners looking at doing a forbearance on the Fannie Mae? And I was hearing about forbearances and that kind of thing happening. And one of the conference calls I was on, they says, no, the forbearance, you'll have to look into the rules the government has set up. Government basically takes over your cash flow. There's no cash flow to be distributed to the partners. There's all the cash that's there has to be paid back, and it's just terrible. I said, no, we won't touch that with a 10-foot pole. But we have done some deals with the tenants. But all in all, because the properties are close to job centers, they're A or B class apartments. We're not dealing, our tenants are not the dishwashers and janitors, etc. And so it's been a very pleasant experience. I think we're getting all the way through it and we'll be done.
That's phenomenal.
That's great to know.
Of course, there's exceptions in markets. Now, we didn't do a lot in Vegas, but Vegas and Orlando, at least for ours, yeah.
Sure.
You kept on saying this property looks good. I don't know. I don't want to roll the dice there.
Those are one horse economies.
Yeah.
Those towns. It's all tourism in Orlando, and it's all tourism in Vegas.
Yeah.
I sent you a MP4. I don't know if you can. Yesterday, Dave, I took the old.
I didn't see it.
Okay, click on it, and it was done by this one. It was done by Grubb and Ellis and those guys, Cory, before Next Point purchased. It was sort of a marketing program.
Oh yeah.
But it gives you a lot of drone shots showing all the job centers within 15 minutes of this property. Cape Canaveral, First One Health, hospitals, big manufacturing companies, all within a half-hour drive of the property. I looked at that and I says, what's going to go wrong here? I don't see it.
So that gets right to the question I was about to ask Cory, which is, you talked about the desire to focus on properties that you believe will show very positive appreciation going forward. And we live in this really, really strange time. The stock market has been at a peak forever. COVID-19 has stopped the world economy, and yet they pumped so much money into the stock market to keep it popped up, but it's not based upon anything real.
Yeah.
And got 40% unemployment. The world is just getting to be this really, really odd, strange place.
So these evening festivities we see on the news. Oh,
right.
Yeah.
How do you want to go there?
So I'm just curious if you could just help us understand how you go about that analysis to determine, what you see happening in a given metro or given area for the next 3-5 years or whatever it is.
Yeah, the numbers. So migration patterns have always been important, and we're continuing. To see some of the same trends that we saw before, kind of speeding up at e-commerce. Taking over from brick and mortar retail, and now not only COVID-19, but also the festivities and the looting is going to make that even stronger.
It's accelerating it.
Yeah. And then the shift of people from, say, Northeast or Midwest markets down to Southeast markets. And so we're waiting to see the numbers. Now, high density areas might see greater migration to lower density areas. And so before COVID-19, we looked at, which states are receiving the greatest, apologize for the noise, which states have the highest domestic in-migration. Florida, as an example, was gaining the highest number of domestic in-migration around the country, and the second highest foreign immigration California, I think, is number one. But Florida, as an example, also had by far the highest percentage of wealthy people moving to that state. People from New York and from Connecticut and from New Jersey who were looking for a lower zero taxes. And so you had Carl Icahn and David Tepper and Trump and others who, established residency in Florida. Florida, of course, an area where they're already familiar with. But overall, the Southeast Atlanta, many of the markets in Florida, the Carolinas have that population growth. And in terms of the job growth, we'll have to wait and see as this plays out. It's too early to have any solid analysis. But we're just reading everything we can. We read all the articles and all of the reports that are available to help us figure that out. I think Orlando will come back. Vegas is an example of a market that Vegas was gaining 42% of California's out migration at one point. Currently, I doubt that's the case. I know that many of the properties, according to the National Multi-Family Housing Council, Vegas had a very, very high rate of rents that weren't being collected, or a low rate of rent collection. And so, but really our focus, Arizona's doing well, Colorado's doing well, the Southeast in general is doing well. Orlando has suffered somewhat, but nowhere near as much as, say, Vegas. And we think Orlando will come back.
If you just think of Disney World itself has 74,000 employees.
Right.
But they're opening up next month.
That's great.
Yeah, they're going away. They'll find a way.
Yeah. Well, they're looking at it going, well, if these rioters aren't catching anything, we can open.
Yeah.
Yeah. It's funny. I follow Ken McElroy's YouTube channel a lot. He's got a really good new one. He's been doing a series on just as the COVID stuff is unfolding. And it kind of aligns what you were saying, Cory, in that, a lot of stuff is just too early. But one of the things he was talking about is what you just alluded to, is that migration patterns are going to be disrupted. They're going to change, and people are going to be primarily looking for, if they're out of a job and they live in an expensive area like California or New York, they're probably going to be looking to get the heck out of there if they're starting over anyway. But they're going to be fleeing to lower cost of living and lower density.
Yeah.
Because you've got now what's the remote workspace is being accelerated. If you look at, for example, Twitter just announced they're going to allow all their employees to work remotely. Now, Google and Facebook are still, they haven't made a decision, he said forever. Google and Facebook have not made a decision on that, but I guarantee you a lot of these companies, that's going to be, I think, if you're competing with employees and you say, no, you got to come to the office every day, and another one says, well, we'd like you in here a day a week, maybe 2 days a week, or, just to touch base with the team. But other than that, you can work remotely. That's a big incentive, because now, okay, I can pay the average one bedroom in San Francisco is what, $3,700?
Yeah.
Something like that.
They say rents are down in San Francisco in the city 9% year over year, but go ahead. Yeah, but somewhere.
All right. So if I can pay $3,700 and work from home in the city, no, I don't think so. I'm going to move out where rent's $1,500.
Sacramento, or somewhere outside of the
Truckee, someplace.
Yes.
Yeah. So it's going to be interesting to see how that plays out, and then of course, people can, you're going to, I think states with low taxes, no taxes, stuff like that is going to be, but
the key thing for the land investor, you have to go where the growth is going to be. Because if you have your investments in land and people are moving to that area, your land is going to be in the path of growth, as they say. And it's home run time.
So when I'm looking at counties at land, I first look at states, then I look at counties, and the first thing I'm always looking at is level of activity. how many vacant land transactions were there on average over the last 3 years compared to the other counties in the state? The second thing I look at is net inbound migration, just like Cory was talking about.
Same thing.
Yeah, same. Yeah, that's great.
And that's, I think that's, for the general area is good, but you could have a county right next to another one. And so you're not going to see, people may be buying properties, but not living there. So it may not show up on the migration. So a little bit of that you can have some flexibility on. Because people still want a vacation cabin over there.
I mean, if you go to, and just to talk about a tool, we could put this in the show notes, but if you go to the U.S. Census Bureau Flows Mapper, you look at net inbound migration, and you pull up not just the map, but you pull up the spreadsheet part of it. It tells you from what counties people are moving into the county you specify, and that includes counties right next door. So, I mean, so long as it's an inbound migration, and so long as overall net migration is going up and inbound migration is higher than the other areas around it, that's the positive indicator, I think.
Exactly.
There was another economic indicator that I was always amused, but I think it's true, is the U-Haul.
Yes.
The U-Haul, what do you say? Where movement? Their pricing.
One-way pricing, yes.
To California, it was like, from Colorado, it was like $1,600. Well, from California to Colorado, it was more like $300 for the same unit because they needed, people were coming here.
Yeah, incredible. So, so the next question is this, I guess, for both you guys, but we just talked about, massive changes potentially in the psyche of Americans and how they're going to make major decisions. I can tell you, having grown up in the Northeast, you can look at cities like Bridgeport, Connecticut, Camden, New Jersey, Trenton, New Jersey, Newark, New Jersey, pick your northeastern city, with the exceptions of Boston and New York.
Manhattan and Boston.
They're all shitholes. And why? Because I can tell you, it's because of the riots that took place in the late 1960s.
Wow.
These cities never came back from that. They never came back. And so what happened, and maybe there were some other things going on, other pressures that were driving people out of the core of the city and into the suburbs. But what happens is, because in the Northeast, at least, the Northeast is different than other parts of the country, right? Because if you're in Denver, Colorado, you could look at various neighborhoods there, whether it's, I don't know, I don't know if it's true about Highlands Ranch, but certainly where I used to live in Lowry, what they consider neighborhoods in Denver would be whole separate towns in the Northeast. They would be incorporated with their own taxes, with their own government, with everything. And so when the people leave the city because it's no longer a safe place to raise your kids, they take their money and their taxes with them. The social requirements of the city go up while the tax base goes down, and it just goes into a downward spiral. And so right now, a combination of, you got COVID, which is if people are living on top of each other, the fear is that they're all going to spread it to each other.
Elevators and subways.
Yeah, exactly. Yeah. Waiters and subways. And now we've got riots on top of it and major disruption. People are saying, I don't need this. I'll just, especially if I can work remotely, and if that now is an acceptable solution for most companies, there's no need for me to be there. Okay. So that's the context. So the question then is, how does that change your investment strategy? Where are you looking now? I mean, is it going to be, in fact, okay, a half an hour from all of these major businesses? Is that really the requirement now? Or how are you going to determine
or 2 hours
exciting place to invest is?
Yes, in our business, we do suburban. We don't really have any CBD property, especially not in the Northeast, and so we're kind of already outside of the highest density parts of any given city. So really, it doesn't change it other than we want to know where they're going. Are they going to this particular suburban submarket or this this area, this county, whatnot? And so, in terms of just overall looking at, I think we really want to. I mean, I saw an article the other day that said, I think the numbers just jumped in New York to over 80,000 people who had requested their mail to be sent to a new address from
change of address.
And so that will continue. And we want to know where they're going. And I think the trends will continue to, the shift to lower density areas where the migration was already flowing should continue, because maybe slight differences, but we should continue to see Florida and the Southeast and the Carolinas and Atlanta. Maybe Atlanta could be an issue in the CBD, but the northern Atlanta submarket should continue to grow, the Norcrosses and the Sandy Springs. And so I think it'll be probably just kind of put in fast forward what was already happening. And in some respects, the migration flows might just be shifted into fast forward. It's a good point though about the whole benefit of being in a downtown, the energy of the downtown, the close proximity to others, the walkability, on the Zillow or the real estate websites, you have the walkability scores. Those depending on how this plays out, the value of that, they may not even need those scores anymore. Maybe you don't want the walkability if the restaurants are closed. And in somewhere like New York City, where they really pack the patrons in, it's going to be really rough. Some of those restaurants it's going to be hard to see how they're going to make it.
Yeah, I think there's a lot of the restaurants they run on such razor thin margins, and you now tell them, you got to live with
50%, 25%
or half. Yeah, a lot of them aren't breaking even until they have 3/4 of the tables full.
Well, you got to have half as many tables, and you have to add $1 million a year for masks and gloves because they got to be changed nonstop. And how do you taste the food? There's a million issues going on with that.
Yeah, that's so. I have two questions with regards to just repurposing and maybe a different trend. So the first one is, one of them is, a lot of this real estate, like restaurants and of course retail space, malls and things like that. It's going to be interesting to see how that gets repurposed and what kind of things, where did I hear it? Somebody famous said it years ago. I'm sure you've heard it. But they said, at some point in the not too distant future, office buildings will become homeless shelters. So there was that, and then the other thing I was thinking was, do you think maybe there might be a trend, especially with any new build apartments, more towards the townhome style architecture to keep things less dense?
Yeah, there is. Actually, we've had what they call horizontal developments in Plano, Texas. We had one, and we had some in Phoenix, and that's definitely there's a trend and a higher occupancy amongst those horizontal developments, and even during this COVID time, they've seen definitely an increased demand without having to share hallways, and of course you got the amenities that people are you're always going to have that. That's always going to be an issue. So how they figure out the amenities and how those play out, we'll have to see.
Right, all those public spaces.
We're heading into a period where there's going to be a shift from ownership to rental, or rental to ownership, or how do you see a movement there?
It had been trending down since the financial crisis, and I think there is. I think a lot of people, a property that Jay and I invested in Chandler, Arizona. I went out there and I thought, well, maybe I'll buy a house and then also buy some of this multifamily property. And after visiting it, I said, why would I buy a house? I mean, you had everything you can think of on demand, workout classes in the gym, 2 dog wash stations, boats you could
total resort.
Just a resort.
Total resort thing. You'd think it was a Ritz-Carlton.
Versus a house, you don't get all those amenities. You'd have to pay a lot of money to have a fitness center like that, and you'd have to pay a lot of money to have that location and those dog wash centers and and the gift wrapping, stations and all of that. So I think there's a trend because it's better. It's better quality of living for a lot of people. It gives them the freedom to move. And the appreciation depends on the appreciation of that market in terms of the housing. When things are really rocking and rolling and we have a strong appreciation, then people tend to gravitate more toward buying. But in California, in this next phase, we had a much milder appreciation cycle, at least for most of California. LA and Silicon Beach and some of the tech-driven markets did see extreme appreciation, but nothing.
Cory lives and works down in Orange County, south of Los Angeles. So
we have a fire economy, finance, insurance, real estate. And so we didn't see quite the appreciation that somewhere like LA, the West LA, or really throughout LA or the Bay Area saw. And it's still appreciating. I'm even looking now, and I think that there's parts of the Bay Area where the flow from Silicon Valley or San Francisco out to the East Bay and other areas continues, and it's as if nothing's changed currently under COVID-19, other than greater demand now. But in California in general, we didn't see quite the expansion phase that we did in previous cycles, and so we have a higher affordability than we've ever had at a peak of a cycle. And so we're not going to have a major downturn. But on the other hand, the appreciation is going to be much milder over this next 7 years. And so in a market like California, I think so. I think people will prefer to rent if they could afford to buy. I think there'll still be a lot of people choosing to rent. Somewhere like Florida, if we do, or the Southeast, I think it depends on what happens. If we have inflation on the other side of this crisis, if we go through a deflationary period and then have inflation, and it's strong enough inflation and it factors into wages, then yes, I think we would see a shift back to buying houses. If we continue down a deflationary period or an L-shaped recovery like Gary Schilling is suggesting, then no, it'll continue to be a renter's market. But with lower wages and lower GDP and just overall deflation, we have to ask how are rents going to be affected and for apartments, and it might be a pretty lackluster period for a little while.
Is it just me, or is it getting harder and harder to count on a job for our financial security? Who would have ever believed that we would go from the lowest unemployment in 50 years to 40 million people unemployed? Whether you have a great job and want to create a second income, or you're recently unemployed, you need to check out land.mba, your one-stop shop for land investors. Investing in vacant land is a proven business model that can help you build a reliable and scalable second income. Imagine a business where you love what you do. There's no limit on how much money you can make. You can operate your business from anywhere in the world with an internet connection. And best of all, you can never be fired or downsized. If this sounds good to you, Land.MBA provides everything you need to get your business up and running and delivering income quickly. You get education, an end-to-end video course and optional coaching to help you get started faster and turn your energy into income. You get tools so you can automate and outsource the busy work and stay super organized. You get access to a thriving community of like-minded investors, which is a powerful way to share best practices and develop potential partnerships for growing your business. And finally, you get access to deal financing, so you never have to pass on a great investment opportunity due to limited funds. Our team has over a decade of real estate investing experience and has the knowledge and experience you need to help navigate any investing scenario. And with Land.MBA, we hold nothing back. Because there are no upsells, you get access to all of our combined knowledge right out of the gate. So don't wait to provide your family with financial freedom. Sign up today for Land.MBA's Soup to Nuts Land Investing video course. Just go to courses.land.mba and use coupon code FREEDOM to get 25% off. That's courses.land.mba and coupon code FREEDOM. And let us help you say goodbye to your job and hello to financial freedom.
It's interesting. I mean, a lot's just so much is going to be riding on how fast jobs come back. Yeah. And I mean, even if we get to a point where, okay, things are turning around and we got a steady 200,000 jobs a month, that's still going to take 5 years just to get the employment situation back to where it was in February.
Good point.
And that's assuming no other major, hiccups. So
a lot of the job growth over the last 10 years has been in the service sector. It's been in restaurants and bars and catering and food service industry and, maybe some hotels and whatnot. That's the business, probably the strongest part of the job market increases. So if
Uber and Lyft and all those guys.
Yep. I do think there are some wild cards out there like 5G. That's huge. I mean, that's really huge. So, those things like that trending in technology and whatnot could change the dynamics a lot. We don't know, but there's some pretty interesting things out there that can happen. But, hopefully it's going to be, and I mean, I definitely see, opportunity. There's going to be opportunities for real estate investors for sure.
Oh, yeah.
And, depending on how long it lasts, whether it's U-shaped or V-shaped, and I'm less on the V-shaped track than I was. I'm more towards the U or somewhere between a U and an L.
Yeah, you were okay. Yeah.
So anyway,
what is happening? That stock market, as Howard was talking about, it's hard to say why it's happening, but it's happening.
It's the Fed put, right? It's the Fed will do anything they can to backstop the market, and investors are betting on it.
And it's never going to hit the economy. It's going to go straight back and pop up those markets.
Yeah. Well, and all the stimulus, let's face it, the stimulus is a stimulus for the wealthy, the guys who own the big apartment complexes and whatnot. That's where all the stimulus is going to.
I was having lunch with a friend of mine that his son manages. He works for U.S. Bank, one of the banks in town, and he handles just a high net worth. To see him, you have to have a $40 million net worth. Some of our car dealers, which you would know, Dave, got $60 million worth of stimulus money out of the last round.
Elway?
Whoa.
No. Healing Doug.
Okay.
Healing Doug Moreland got $60 million, and that's to sustain his payroll. He's got 11 dealerships or so. So it's just, you're right about the rich getting richer.
Yeah, I mean,
it's always a good idea to watch what the rich people are doing because they typically have some very good information. So
very smart.
About 3 years ago, maybe even a little bit longer, 3 years ago, Connecticut's an interesting place to benchmark because about 3 years ago, we lost literally billions of dollars in annual tax revenues. And the billions. And the reason is because 100 hedge fund owners closed their doors and probably moved to Florida. And, they're always, they are the canary in the cane. If they're seeing this is not a good time to be playing in that market anymore, I'm going to get out of Dodge. All right. So now they're kind of getting out of that game. But of course, they're obviously incredibly bright guys with a lot of money to invest and, and they stay invested and they always find a way to make money. So, where is the wealth going today? I mean, if you say, well, look at, the markets, maybe I'll continue to play the game a little bit because I've got information that says we're not at the point yet where the bubble's going to pop, right? But if they start to get to that point, where are they going to want to put their money? It stops being a little bit about wealth preservation, a little bit more about wealth accumulation. It becomes a little bit more about wealth preservation. And now we start getting into things like gold, stock, fine art, real estate, and so. And land being a category of real estate. And so I guess what I would expect to be seeing, if you guys haven't seen it at all, and maybe the question is to you, Cory, I would expect to be seeing more of that high-end money trying to find its way into real estate deals as a way of parking their cash, especially if there's any fear of inflation.
I was thinking the same thing. We haven't seen it yet. Starting to see it a little, especially here in California, and a lot of it is, but a lot of that is already real estate money concerned about all of the laws being put in place in California, which is really scaring a lot of real estate investors. Even bills that were voted down, the state assembly came up with their own rent control law, even though the proposition was voted down. So we have that going on.
Yeah, what percent? That was interesting. We were talking about that, Cory. They had a ballot issue about statewide rent control.
Yep.
And let's hold down these rents. And so they put it to the citizens, and what did the citizens say?
And they voted against it. I'm just looking up, defeated by a 59.4% to 40.6% vote.
Huge.
And then they went ahead and enacted the law anyway, or their own law anyways. And now they're redoing it. They said they didn't go far enough. And they're talking about they're actually talking about a 25% reduction on rent across the board for California, any California tenants who have been affected.
Howard and I were very young boys when they said California was the land of the fruit and nuts. And
and don't forget flakes. It's a bowl of cereal.
Yes.
I spent 27 years of my life there. So,
yeah.
born in LA, grew up in the Bay Area, went to school at Long Beach State.
Oh, cool.
I actually used to live in Huntington Beach too.
Oh yeah. Okay, great.
During college.
We're right in downtown. Some of the stores right here in downtown Huntington are boarded up, and we had some riots, or not riots, but some outbursts and some break-ins on Sunday.
Not fun. Yeah, I lived in Long Beach during the Rodney King riots.
Oh wow, yeah,
yeah. Did not go outside for a few days.
Yeah.
Yeah, all my Marine Corps buddies that I typically chat with, we're talking about how they're going to be sending the military and how it's it's going to become the new normal. Just like now, you never walk through Grand Central Station without seeing people all dressed in black with M16s, and now the level of military or police engagement in cities is going to go up, and it's going to become much more normal and accepted, which is a very scary thought. And that's what I put. My other friend said, "So you had a problem with the Marines going in to the LA riots in '94, whatever it was?" I'm like, no, I didn't.
In Paris, on all the subways, etc., that they had machine guns, and this was 25 years ago.
Yeah,
for sure.
Crazy times.
Yeah. All right. So, all right. Let's end on something. We got down this negative track. Let's give us something positive to end on, guys.
Yeah. So where should land investors be looking right now, as even if we just did it at a state level, what states are looking really, really positive for real estate investment and potentially land investment?
Cory, you've got a good feel for that.
Yeah, I think Arizona, Texas, Florida, North Carolina, Georgia.
All right.
I would not
My
disagree.
property's in Texas. You didn't talk much about Texas, but I'm still involved down there, and they're doing very, very well.
Yeah, I've got a nice piece of land I'm closing on in Texas soon. Actually, yeah, pretty stoked about it. And Colorado has just been that's been my stomping grounds, and it's been done good for me. So.
Oh yeah. We we went into Colorado, my brother and I and our investors back in 2005, and it was a counter-cyclical market, and it's one of those markets where it continued to defy previous counter-cyclical peaks. I think because there was a paradigm shift. They had a tech economy in Denver, and it just it's continued.
A nice day.
Yeah.
Yeah. It used to be a one horse economy, and that's probably about the time when it really started to shift and diversify, and the tech started to get, wasn't just energy and ag anymore. So for sure. Gotcha. All right, guys. Hey, we thank you for spending your day with us, your time. And it was, I hope the viewers and listeners got a lot of benefit from this and got some value. I sure did. And hey, so Cory, why don't you just tell we'll put it in the show notes along with your PDFs that Jay sent over, but tell us the best way for our listeners to reach out to you if they're interested in learning more about what your company has to offer.
Yeah, sure. You're welcome to call me direct at 949-874-0556 or 888-295-1031. And our website is IPA1031group.com, or you can just type in IPA1031.com. That's IPA, Income Property Advisors, 1031.
India Pale Ale 1031.
You got it, yes. That's
right. Making me thirsty. All righty.
A lot of people ask, and Cory and I discuss about it quite a bit. The legislature, the government, the feds, the House, the Senate has not been looking at the 1031 as a method to raise taxes, etc. It's been somewhat untouchable.
That's good, and let's hope they don't touch it, because it's
marvelous.
It would be catastrophic, I think, on the economy if they were to eliminate it. It creates so much wealth.
Absolutely.
And enables. And one of the things I love about the something they did in the Trump tax law was the inheritance, where the values rate up when it transfers to the survivors. And that's huge. That's huge. I know, my dad had some buildings that he had for a long time, and, transferring to my mother, she could put those, she didn't have to, if she wanted to put them in a different asset, she didn't have to do 1031 exchange. She could just liquidate and put them in cash or stocks or whatever she wanted. So
the roll-up basis, that's all.
The roll-up basis.
Yeah.
Step-up basis. Yeah. That's a great thing too. But you don't want to have to die to not pay taxes. So 1031 exchange. So, hey guys, have an awesome day. Really nice to meet you, Cory. Jay, good to see you as always.
Likewise.
Howard, you guys have a great day. We'll talk soon.
We hope you enjoyed this episode, had a bit of fun, and walked away with some actionable insights that you can apply to your business. Dave and I have got some great content and interviews planned, so don't forget to rate and review, and of course subscribe to this podcast on iTunes, Google Play, Stitcher, or wherever you get your podcasts. If we mention any interesting links or tools, you'll find them in the show notes. To learn more about Land.MBA, visit our website at, wait for it, Land.MBA. See you next time on the Land.MBA podcast.